I was going to give a talk with a very boring title. It was something like challenges for the U.S. economy in the next 10 years, 5 years, I don't know. And then, as I was watching the debate last night, I decided that this was a talk that we had to have today. And it's about Mr. Taylor and us. And some of you have come to me and asked me, who is Mr. Taylor? And that, of course, is part of the mystery. Who is Mr. Taylor? And why should we care about Mr. Taylor? So I'm going to try to persuade you that we should care about Mr. Taylor. So one of the lines in the debate yesterday, I don't know if all of you saw it, but if you haven't seen it, take a look at least at the highlights in YouTube or somewhere where you can find it. But one of the lines that came up yesterday came up from Donald Trump, who intimated that there is a huge conspiracy going on in this country, and that the chief conspirator is Madame Yellen, whom you can see there, who is the chair of the Federal Reserve System. Coincidentally, one of the front page stories in today's Financial Times, why coincidentally? Because the Financial Times is printed in London at a time that, of course, they didn't have the information about the debate. One of the frontline stories is about Janet Yellen and this conspiracy. And the alleged conspiracy goes this way. So what the Fed has done, according to Donald Trump and others, I suppose, is that it has deliberately pushed interest rates down in order to create a false sense of prosperity. And that as soon as President Obama steps out of the White House, then interest rates are going to be raised very rapidly. The bubble, it's going to burst, and we are all going to go, and I'm sorry for my friends here at the main table, the way of Brazil, right? Which is not exactly today the best way to move forward. So in this narrative, Janet Yellen and the Fed are all powerful. And what I'd like to talk is about the Fed. And what I'm going to argue is that it's not Miss Yellen, the one that has all the power and that is going to determine what's going on in terms of interest rates, cost of capital, and other things that the Fed affects either directly or indirectly, but it is Mr. Taylor. And Mr. Taylor is a good friend. Some of you that have taken my class maybe remember that we talked briefly about him. His first name is John, and he is a professor at Stanford. And he holds a joint position at Stanford and at Hoover Institution. And a few years ago, John Taylor derived or devised an equation. Right? So equations sometimes are useful. And that equation has been named the Taylor rule. And directly or indirectly, either if they recognize it or don't recognize it, every central bank in the world today is run by the Taylor rule. So let's talk a little bit about the Taylor rule and what the implications are for what's going to happen to the Fed. And then we'll talk a little bit about why that is of utmost importance for board members. And we had, it's the middle of the year, we had our compensation committee meeting, a very long meeting, at one of my companies. And without knowing, all of my colleagues, geologists by training, people in the natural resource field, were talking about Mr. Taylor. And when I pointed that out to them when we went out to dinner, very, very fine restaurant in Chicago, the company is doing very well. So we are upgrading the restaurants where we go to dinner. They didn't know who Mr. Taylor was. So we had a Taylor conversation. So this is the Taylor rule. It's a very simple equation that John Taylor devised. And what the Taylor rule says is that the interest rate the Fed ought to set, that's a little r, it should be governed by this equation, where pi, as we economists always do, it's inflation. Pi star is target inflation. So let's assume that the government wants to have 2% inflation, and inflation is actually 2%. Then that expression is 0. And U star is what economists call the natural rate of unemployment, so really low unemployment, say 5% in the US, and U is the real rate of unemployment. So the Taylor rule says that if inflation is very high, higher than target, you hike the interest rate. And if unemployment is very high, you lower the interest rate. And if you do a Google search, and I do this in my class, Taylor rule for India, there is 2 million entries. And you do Taylor rule for Brazil, it's 1.9 million entries. And you do Taylor rule for Burundi, there is 35,000 entries. Every scholar in the world, every grad student, every undergrad student is doing Taylor rules. And every central banker is using Taylor rules. So the other thing that John Taylor said is that this number, alpha, is a coefficient for the US should be 1.5, which means that if inflation goes up and exceeds target inflation by 1%, the interest rate that the Fed sets, the federal funds rate, should go up by 1.5%, and this other number should be 0.5%. So all these grad students that are doing Taylor rules for other countries, what they are actually doing is trying to calculate the alpha and beta, and they are paid obscene amounts of money for doing that, right? So what did Taylor do? He published this little book in 2012, I believe, and he said the following. So I want you to pay attention to this because this is the most interesting part of the talk, and it's interesting on itself. So Taylor said the blue line is the Greenspan interest rate during the bubble. So the Fed lowered interest rates to 1% and kept them at 1% for a long time, and this is what Greenspan did, the light blue line. And John Taylor said, had the Fed followed my rule, this is very self-centered, had they followed my rule, the interest rate should have followed that particular path. So the rate should have been raised, it should never have gone below 1.75, 175 basis points. Every reduction below that was wrong, according to Taylor, and it should have stayed at that level very, very short period of time, and then it should have been raised and should have gone to 5.25 very quickly. And what is interesting is that Taylor says if that rule had been followed, the blue line would have been the amount, the number of housing starts in the United States. And the blue line is what he says would have happened, counterfactual, and the red line is what actually happened. And this area in between red and blue is the housing bubble. And according to Taylor, the whole crisis was the result of the fact that we kept the rates too low for too long, and we overbuilt houses, and then there was a bubble. Now, what is happening today with the Taylor rule? There are two things. One is that, as I said, every central bank is using it. And two, there is an initiative in Congress to introduce the Taylor rule as a required guidance for the Fed. And if the Fed deviates from the Taylor rule, the chairman or the chairwoman of the Fed has to come to Congress and explain why she is doing that. So we're going to be now governed by an equation. So let's talk a little bit more about what the Taylor rule tells us. What do we think inflation is going to be in the future? This is expected inflation in the US, and we can see that it is around 2%, 1.75%. So it's more or less where the target inflation is. But unemployment has declined very significantly. And that is the reason why the Fed is going to raise interest rates almost for sure in December. So Donald Trump is right in the sense that the rate is going to be raised in December, but it's not because Janet Yellen wants it to go up. It's because the Taylor rule says it has to go up, and now everyone is following Mr. Taylor. So why does this matter? What does history teach us? And I'm going to talk a little bit about that and about a few other things. So why does this matter? Well, it matters in part for the reason, one of the reasons that Donald Trump talked about yesterday. And that has to do with valuation and whether there are bubbles. Okay? So in general, one way to think about valuation is that we get to valuation by dividing 1 by the interest rate. Not really 1 by the interest rate minus the rate of growth of the economy. And for a very long time, the price-earnings ratio for the Standard & Poor's index has been around 14. Now, right now it's 20. So it's higher, but it's not like bubble-like. And the question is, can we justify it with the lower interest rates? And let me not go into the details. The answer is yes. And if the interest rate goes up, we are by 200 basis points, the price-earnings ratio will gradually move back to around 15, 16. So the stock market doesn't seem to have a bubble. Now, real estate is a different story, but there we have to be very careful, as our colleagues here at the Ziman Center tells us. It depends on the zip code, it depends on the city, it depends on a number of other things. So we worry about interest rates because of valuation, but we worry about it for other reasons, including exchange rates and capital flows. Let me now say a few words of what does history tell us. Right? So the Taylor rule tells us the interest rate is going to go up. Donald Trump tells us the interest rate is going to go up. Everyone thinks the interest rate is going to go up. The futures market says there's 75% or 80% probability that it will go up in December. How much will it go up by, and for how long, and what will happen? So does history tell us anything about it? Well, I have here data on the federal funds rate all the way back for 25 years. And what we find out is that history doesn't help us too much. And it doesn't help us too much because in 25 years there have only been 3 episodes of interest rates hikes. Now, the one thing, I said 3, but there are 4. Okay, so I didn't circle that one. And that's the most interesting one because that's the only time the last 25 years, and you can go all the way 40 years back, when the Fed raised rates one time and stopped. Every other time it continued raising it for quite some time. And this is 1997. And what happened in 1997? On July 4th, the Thai baht went to hell, collapsed. And the next day it was the Malaysian ringgit, and then it was the Philippine peso, and the Korean won, which people thought would never collapse, collapsed in November. So it's the East Asian crisis. So the Fed was ready to hike rates here and maybe move them to around where they eventually went, 6.5%. But it didn't do it because of the Asian crisis. So now that the Fed already started in December of last year, and it's taken a while for the next move, the only probability, if we look at history, the only event that could derail that series of hikes would be a crisis as deep as the East Asian crisis of 1997. And that immediately brings to mind China. Will there be a crisis in China? We'll talk a little bit about that in a minute or so. Now, the federal funds rate, which is the one that the Fed moves, I don't know if it exists. I mean, I read that it exists, but this is like when Perón in Argentina asked a rally in the 1950s. They say that because of our policies, he was a populist, like 1950s version of Chavez or Maduro in Venezuela. He said they say that the dollar will become too expensive. And he asked the people in Buenos Aires, very poor people, how many of you have ever seen a dollar? And no one raised his or her hand. So the dollar doesn't exist. It's an illusion. It's an invention by the rich in order to soak us. So does the federal funds exist? I haven't seen a federal fund ever. But what is important is the 10-year rate. And the question then is, what happens to the yield curve, which is the spread between the very short-term interest rates, the federal funds rate or the 3-month bill, and the 10-year interest rate. And what we have here is the 3-month red and the 10-year blue. And so let me move forward to the Greenspan Conundrum. Okay, what's the Greenspan Conundrum? The Greenspan Conundrum is Alan Greenspan's reply to John Taylor's assertion that if Greenspan had followed the Taylor rule, there would have been no subprime crisis. This was very strong. John Taylor was a buddy of Greenspan. He was supposed to replace Greenspan. And then the president chose Bernanke. Now, no one knows why, but that's what happened. And Taylor then writes this book and publishes a series of articles in the journal saying Greenspan totally screwed up. If he had followed my rule, there would have been no subprime crisis. Greenspan came back saying Taylor is wrong because we were facing a conundrum. The most beautiful word, or one of the most beautiful words in the English language, conundrum. It sounds well. It's, if you say it, people think that you are really learned and that you are a scholar of some sort. Robin tells Batman occasionally, Batman, this is a conundrum. So in the Batman movies, conundrum is used. So why are we worried about the Greenspan Conundrum? Because it may happen again. So what is the Greenspan Conundrum? The Greenspan Conundrum has to do with what I was saying a minute ago, which is the difference between the federal funds rate, this blue line, which is the interest rate that the Fed sets. And that's the one that they are going to raise. Now it's between 25 basis points and 50. And it's going to go now more in December and furthermore next year. And the 10-year rate. That's the red is the 10-year note. That's the one that matters to us as business people. Credit card rates are based on 10-year. If you float bonds, the benchmark is 10 years. If you buy or sell Argentine securities, the base is 10 years. Every spread is over the 10 years. So the 10 years is the one that matters. Okay, so here is what happens. We have 3 episodes again. The Fed hikes the rate. The 10-year rate goes up. My colleague, the learned Professor Limer, told me today, oh, the 10-year was moving before the Fed rate. I said, I don't care who moved first. They moved together. The Fed hikes rate, the 10-year goes up. So when the Fed tightens, that tightening is felt throughout the yield curve, and builders and people that ask for credit and mortgages, they all feel the tightness and they react. And that's the way the Fed tries to affect the economy. And the conundrum is that here, the rate was hiked and nothing happened with the 10-year rate. And what Greenspan said, in the global economy, what really matters is what the global participants are doing. And now there is a savings glut. Too many people are saving, there are too many funds, and even though we raised the rate, the 10-year rate stayed flat. And had we raised the rate at the time when Taylor wanted it to go up, the conundrum would have been there and nothing would have happened, and we would have had the bubble no matter what, the housing bubble, because what determines the housing bubble is the 10-year rate. So we have to worry about whether the conundrum is going to happen again. The Fed, as I told you, is going to continue raising rates. Why? Because the Taylor equation says that it should raise rates going forward. It will not stop soon, because it has never stopped soon. It will continue doing it. And what we don't know is what is going to happen to the yield curve. And if the 10-year rate does not move, then the Fed will be hiking rates and it will have no effect on the economy. What's the answer? Will the yield curve move, continue to have the spread, and will the 10-year move up? I believe so, but I cannot give you a guarantee. I'm an economist, I'm not a magician. Let me say a couple of words now about the global economy, and then I'll stop. there is something very important today that is different from 10, 15 years ago, and that is that every country is much more integrated and it is related to each other. So what I have here is another way of looking at the Fed policy. And this is another thing that Donald Trump and others have argued. This black line is the size of the balance sheet of the Fed. These are the liabilities of the Fed. And the liabilities of the Fed is credit that it has created and currency and so on. And you can see that it went from nothing, 800 billion, nothing, to 4.5 trillion. And it kept going up. This is when the crisis exploded and the Fed continued, and this is QE. And then now it sort of has become flat. That's the tapering off of the Fed. But the European Central Bank, instead of creating more liquidity, started tightening in 2012. So why did, and the problem, and then they reversed, and now they are also, they are increasing. But the current global situation, it's in large part the result of the Europeans having tightened at the wrong time. And you can see there that as the Fed pumped more money, Europe started. So why did Europe behave like that? And then you say, well, they were looking at the Taylor rule. That has to be the only answer. And, well, it doesn't look like that. If you look at inflation, remember, the Taylor rule says you raise interest rates if inflation is too high, and you lower interest rate if unemployment is too high. So inflation in Europe in 2012 was as high as in the US. They should not have, it was not higher, it was lower, in fact. So there's no reason for them to tighten because inflation was not out of control. What about unemployment? This is a fascinating diagram. Unemployment in the US is the black line. And it says, well, it went below 5%, and this justifies why the Taylor rule then kicks in and says unemployment now is below what is normal or long run, so we should hike interest rate. But in Europe, look where it stayed, at over 10%. Now, here comes the answer to all the European mysteries. If you deconstruct Europe, the Eurozone, this is not all of Europe, the Eurozone, between Germany and the rest, this is the German unemployment. Germany has a lower unemployment than the US. So what happens is that the European Central Bank is running monetary policy as if they are running it exclusively for the Germans. And we have here Al Carnesale, and he will say, he's a world expert in geopolitics, and it's not surprising. The Germans run the European Central Bank, and the Taylor rule for the Central Bank of Europe doesn't pay any attention to the fact that it's 25% unemployment in Spain, who cares, and 40% unemployment in Greece, and 40% unemployment in Portugal. It is tight in Germany, so we're going to tight monetary policy because it is the Germans, the ones that run the policy. Okay, let me say a few words and then I will end about exchange rates. One of the reasons why we should worry about the Taylor rule and all of this, at least in my field, is that interest rates are the fundamental determinants in the short run of currency values. And I was at this compensation committee meeting the other day, and in this particular company, our peer group is made up 75% of Canadian firms. And we could not increase the bonuses to our executives without getting completely off the chart. And we asked the consultant, what's going on? I mean, the industry is doing very well. Every company is doing very well. How come that? What's the matter? I say, oh, it's currency. It is because the Canadian dollar is moving in the wrong direction. And now when you translate their bonuses, they're getting higher bonuses, but you translate them into dollars, then they're coming down. So we have to then write, and Glass Lewis and these guys will have to get an explanation from us so that we get a positive vote and we're not kicked out of the board because we like going to dinner in Chicago, right? And we have to try to explain them that it's a currency problem. It's not that we are overpaying our executives, it's a currency problem. And the currencies depend and respond to interest rate differentials through the carry trade. If a country raises interest rates and everything else stays constant, that currency strengthens. And if we're going to start pushing our rates up, if the Fed is going to start raising rates, and the Europeans, which are trying to sort of undo the harm they did by following the Germans, don't do that and continue to have negative rates or even further negative rates, the dollar will start to strengthen. And that it strengthened a little, and then and that will have consequences for everyone else. Let me just finish with this graph for the dollar, which is a very interesting one. This is the value of the dollar adjusted by inflation. It's what economists call the real exchange rate. And it is a trade-weighted, there are 26 different currencies that come into this average. And each of these currencies comes in with a weight that is as large as the importance of that country in the trade with the US. So which country is the country that is number one in our trade relations? Here, China? Wrong. Canada, by far. Canada is our number one trade partner, followed by? Wrong. China. Okay? And then Mexico. Okay, so we can see that the dollar, when the subprime crisis came, had reached one of the lowest values, and it was moving towards one of the lowest values, and probably the lowest ever in the history of the dollar. And after the crisis, well, it went up, then down, but now it's done very well. And it's likely that if the Fed raises rates, there are two things that are going to happen. Some countries like Mexico will follow the Fed. And we have seen that the Mexican Central Bank changed the dates of its meetings. Meetings for these committees are set 5 years in advance, dates. And the Central Bank of Mexico changed the date in order to have the meeting the day after the Fed, so that they could, if the Fed raises the rate, they will do it immediately. But there are going to be other central banks like China, like Japan, like Switzerland, like Sweden, and the European Central Bank that will continue to have negative rates, and that means that with all likelihood, the dollar will continue to strengthen. This is the yuan. I said we'll talk if we have any time. So Mr. Taylor is all-powerful. He didn't get the job of chairman of the Fed, but now every central bank in the world is run by a computer that uses his one simple equation with only 2 Greek letters. That's amazing. Thank you so much.